In this video, I will show you the best way to pick great stocks when the market is overvalued. Right now, the S&P 500 is trading at a PE ratio of 30. So if you compare this to historical averages, the US market is a bit expensive. Not in a bubble level, but a bit expensive. So how do you pick great stocks when you have an expensive market? Welcome to this video. My name is Christophe Nour. I've been investing in the stock market for almost a decade now and I have achieved a performance of 25% per year. So in this video, I will show you some tips so that you can pick great stocks that are cheaper than the market. And if they are cheaper than the market, and if they are great quality, great stocks, great companies, it's very likely that you will do fine. You will have a great performance in the future. So let me write some stuff and let me start with the beginning. Let me O for outperform. If you want to outperform the market in an expensive market, the first thing you want to check is the balance sheet of these companies. We will do a bottom-up analysis. So we want to start from a safe zone. Right now in the US, you have some inflation, you have some high interest rates, you have some uncertainties when it comes to the conflicts, new presidency, China risk. So you don't want to invest in weak businesses. You want to invest in businesses that are strong financially. And how can you see if a business is strong financially? It should have a lot of cash, minimal amount of debt. This is an interest rate risk that you want to avoid. So if you focus on the balance sheet first, you will only invest in companies that don't have a lot of debt. You remove a risk like this. This is a good way to outperform because I'm telling you what will happen in 2025, 2026. Some companies that have a lot of debt will have to repay the debt, or they have to take another debt. And now it's not cheap debt. Now the interest rates is not at 0% like in 2020. Now the interest rates in the US are around 5%. So you have to pay your debt and to repay it with some interest rates. And that will be a drag on free cash flow available for you as a shareholder. So now if you invest in a company, for example, let me write, it will be easier. Let me put this situation with the balance sheet with no debt and a company with debt. Okay, two scenarios. Imagine you have the same growth rate, the same efficiency, etc. You have two scenarios. The company without any debt in 2025, 2026, they will be able to use their free cash flow they generated to reinvest in the business itself. And it will generate more cash flow and then will reinvest. So more cash flow, more cash flow. You have this snowball effect that will compound the business over time. Compare this to the situation where you have some debt to pay. So imagine you are in 2025, you generate some good free cash flow, but you have to repay your debt. So all your free cash flow will go to the debt repayment. You won't be able to reinvest inside your business. And if you have some reinvestment opportunities, you can't reinvest. So you will not grow as fast as the business without any debt. So you can reschedule your debt. You can perpetually increase your debt level. That's an alternative, but that's more risky. The more debt you have, the more risky you are if we enter a recession. If we enter a difficult environment, if as a business you face some specific challenges, industry as a whole. So if you want to outperform the market and pick great stuff, great stocks for this market, I would recommend to focus on companies without any debt. Okay? That's the first point. Now you want to outperform the market, so you want to focus on earnings growth. It's all about earnings, right? If the earnings per share of a company is growing 20% per year, in the long term, it's very likely that the stock price will grow 20% per year. So you want to be 95% sure that in the next 5 years, the earnings will be higher than what they are currently. It's this metric inspired by Warren Buffett that will avoid you a lot of mistakes. If you focus solely on companies where you are quite sure earnings will grow, you can't make a lot of mistakes. So only with these two arguments, these two elements, safe balance sheet, safe earnings growth, you avoid the mistakes, which is what we want in the markets. We want to perform, but most importantly, we don't want to fail. We don't want to lose a lot of money. We don't want to lose hair. We don't want to have a lot of stress. We want to be able to sleep well at night. So this is a good way to invest when the markets are overvalued at the moment. Now let me check some notes. Now you see that in 2023, 2024, the AI sector, the tech sector, has received a lot of inflows in the market. And this money came from somewhere. Inflows and outflows from one market to another market, from one industry to another industry. That means that in the market right now, even though the S&P 500 is expensive, in the S&P 500, you have some pockets in the market of companies that have seen large outflows of money. But these companies are still well, are still fine, are still decent, are still profitable, are still efficient. So you can check, let me put O for outflow. Let me explain what I mean. For example, in the construction sector right now, we have seen a lot of outflows in the market. In some construction equipment companies, we've seen some drawdowns. These stocks are crashing, and these are still well-run companies with nice profitability and still growing. So you have this discrepancy between business quality and flows of capital, flows of money. Find this pocket. Find this pocket. It will be very, very helpful. I've shown you an example, but you have other pockets in the market. Great businesses, great management, great moat, but at the moment, this is not a trendy environment for them because all the cash, all the inflows went into the AI market. So just run a screener, read some things on the internet. You will find some great articles that talk about the inflows, outflows of money. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. That's a very good way to invest in this market, I would say. Maybe that's the most important aspect of this video. That will be how you generate strong ideas that nobody wants at the moment. Trends come and go. The fads come and go. Inflows and outflows of money change rapidly. And now you might say, no, AI is here to stay. Let me remind you, not so long ago, that in 2020, 2021, everybody was talking about tech, Apple, Amazon, Facebook, Google, tech, digital environment, lockdown, pandemic, tech. And then in 2022, everything turned, everything shifted. And now tech was not growing. It was all about oil and gas because of some conflicts, because of high commodity prices, because of inflation. And what was what the best sector with the best inflows in 2022 was the oil and gas sector, the energy sector. So this can turn. And now, for the past 2 years, we've seen some strong inflows to AI, to tech. But it can turn again. And if the tide is turning, it will turn fast, really fast. You have to be prepared for this one. That's why you want some exposures to underperforming market with large outflows. But don't be cautious, by the way. Don't purely invest in energy. There are some bad businesses in energy. This is why I started with the balance sheet. You want to avoid that. And that's why I also talked about earnings growth. So inside these hated sectors with large outflows, check the best businesses, best moat, best management, best growth runway. Now, you have something that is quite important. This is the pricing power of a company. It's very likely that in the coming years we will have some inflation. The interest rates are unlikely to go back to zero. So the world will get more uncertain, as always, as every year. And if we have inflation, if we have high interest rates, you definitely want to invest in a company with pricing power. So how do you invest when the market is overvalued? You check these 3 criteria and you mostly focus on companies with pricing power. What do I mean by pricing power? For example, if my iPhone breaks for some reason, I will buy a new one. That's the Apple ecosystem. I don't want to switch to Samsung or to other smartphones. I will buy a new iPhone, and if the iPhone is more expensive, like $200 more, $300 more, I don't care. I will just buy it. That's a pricing power. The customers will still buy your product even after the price increase. I would not say the same thing about supermarkets, retail companies, low-cost producers with thin margins. So how can you invest in companies with pricing power? You can check their gross margins. GM. Their gross margins. The gross margins are the revenue minus the COGS, the cost of goods sold. If you have a gross margin above 50, 60%, that shows you have some good pricing power. And to the contrary, if you have a gross margin of 20%, you don't have a pricing power. So inflation will hurt you badly because the costs are high. The costs, you are capital intensive, the costs associated with the growth are really high. So how can you focus on these 4 names? You can invest in the US, you can invest internationally. You will have cheaper names in Europe, in Asia compared to the US, or even Mexico and Canada. You can run a filter, a screener with these filters, these criteria. You have 4 criteria right now, so you can put them in a screener. I'm using FinChat. You have a link in the description below. You will have a discount. It's cheaper with my link. And you put that in your filter that you want to invest in companies worldwide, okay? Any country in the world. That would be a good starting point. Without a lot of debt. You can put any ratio for debt, that's fine. Debt to equity or just cash level, net debt, that works really well. You can put future earnings growth. You don't want an extremely high earnings growth. Don't put earnings growth like 20% per year, 30% per year. It will be almost impossible. But you want some reasonable earnings growth. 10% per year is fine. You want outflows of capital. That you have to do more qualitative work. And you put pricing power. So in your filter, you put gross margin above 50%. If you do that, you can find extremely well-run businesses that are available. And the only thing that remains is the price. Let me put a 5 here. 5. You can check the PE ratio, price earnings ratio. You can check the price to free cash flow, price to book, price to sales. I would say the most basic metric for valuation is the PE ratio. We talk about profitable businesses with earnings growth. So it's a good metric to see the valuation of a business. You want the PE ratio to be below the market average. If the PE ratio for the S&P 500 is 30, you want the PE ratio of this great business to be below 30. You can be a little bit more conservative and you can only invest in PE ratios below 15, and that's fine. And that is exactly the formula how to find great businesses, undervalued businesses when the market, the S&P 500, is overvalued. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.